Today is Friday, February 3rd, 2023. I'm Jason Shapiro with crowdedmarketreport.com. The past week or 2 weeks have really been a laboratory for some of the things that I try to talk about in terms of how I feel the market really works and the market really reacts. There's so many examples and so many talking points. I hope I don't go off on a tangent here, but I'm going to go through it a little bit, and we could pick so many markets, but let's start with the stock market, okay? The stock market, and in particular NASDAQ, in the last 2 weeks has gone through a rip. And what I've been talking about on our newsletter and everywhere, on Twitter and everywhere, was that people were so short coming in to the last couple weeks, right? So bearish and so short. I heard it on the financial TV and news networks every single day. Every single person that came on said the same thing, which is that they were bearish. It was, I kept calling it, a bear parade, right? And these are people who I have listened to for a long time, and it's one thing when one of them who I know is a great fade is bearish. That's good. But it's another thing when every single one of them is bearish, right? To me, it just increases the odds. So that's what's been going on. And if we look at positioning, which we know is my favorite thing, this is the Commitment of Traders report for the NASDAQ, right? This was last Friday. This was the Friday before. Even the Friday before, we were showing speculators look how short they are compared to history. Look how long the commercials are compared to history. Market went up. They got even shorter. They were selling into it. So the Commitments of Trader was confirming what I was hearing on TV, and that's very, very powerful. This is positioning. And one of my favorite fades came on TV, and he's been short, buying put spreads on basically everything, QQQs, everything. And he was getting all angry that the market was going up, which is, first of all, a good sign that it's going to continue up. And he said something like, I realized that, people were maybe bearish coming into the year, and I realized that they were maybe short coming into the year, but sentiment and positioning is not everything. Fundamentals matter. And I'd love to hear him say that, because in my view, as a trader, sentiment and positioning are everything, okay? And fundamentals don't matter. And the reason that fundamentals don't matter is because everybody is paying attention to them. So therefore, it's discounted in the market, right? And that is seen by the fact that everybody was short, right? So sentiment and positioning is all that matters, I would argue. So here they were with the NASDAQ, and they were super short, and we know what the NASDAQ did. It went straight up. And I know people want to say things like, oh, well, the Fed came in and was dovish or whatever, right? And I'm here to say that the Fed was not dovish, right? The first thing, I was watching it. In retrospect, after the market went up, commentators went out and said, oh, well, there was that one question that they asked Powell, and he said this, and that was much more dovish than you would have expected. But in live time, okay, what it said, I'm just reading it from here, on the TV was, I saw the headlines on Bloomberg TV while it was going on. Ongoing rate hikes are appropriate. Dovish? Okay. Inflation remains elevated. Dovish? No. Positioning short, sentiment terrible? Yes. Okay, that's what it was. You can blame it on the Fed. You can blame it on whatever you want. Okay, that's what it was. All right, you're not going to come out in retrospect and tell me that the Fed was dovish. If the market had gone down, you would have said the Fed was hawkish. Okay, positioning, sentiment. All right, and I wonder if the Fed was so dovish, then why was it all NASDAQ driven? Why didn't the Dow go up? The Dow was basically flat, which, by the way, if you were bullish this last couple weeks and you were long Dow, you're pissed off because the Dow's gone nowhere, right? Whereas the NASDAQ, obviously has ripped, okay? One bad decision. Long Dow, not long NASDAQ, and it's a whole different game. So let's look. Can we figure out where that was? Well, this is the NASDAQ Commitment of Traders. This is the NASDAQ positioning. All right? Here's where they're super short. And here is the Dow positioning. A huge bunch more neutral, right? The commercials were a little bit longer here in the middle of December, which is when the Dow was outperforming. And then they came off, and the Dow way underperformed. And just as an aside, here's the Nikkei, where the speculators were also super short. And lo and behold, here's the Nikkei, which is ripped, right? So, sentiment positioning, okay? That's where we're going to get our risk reward. There's no guarantee, but that's where we are going to get our risk reward, all right? I could pick so many markets here, it's silly, but one of the things that I was saying a lot on Twitter, in particular this last week, was I thought that the NASDAQ long versus a short in energies and metals was a great trade. Why did I say that? Again, everybody on TV was saying buy oil stocks. Everybody on TV was saying buy mining stocks. They're bearish, the stock market, but they think oil stocks are good. They think mining stocks are good. All right, that's what I heard every day for 2 weeks, okay? And then again, let's go to the COT. Crude was really nowhere, but here, longest speculators were gasoline. That's the RBOB chart in this entire thing, right? This is the commercials for heating oil, okay? Shortest commercials were heating oil, okay? They were shorter one time right here, right? And then we look at what those wonderful markets did this week, right? Here's gasoline, right? It's a big move down, in particular, you know, in a stock market that's going up, right? Here's heating oil, right? Crushed, right? Metals, here's gold, right? Here's silver, okay? So these are sort of the good things. And again, what you wanted to do, if you see this, you don't just do it right away. Hey, this guy on TV that I think is a fade said, you know, be long oil and be long gold, so I'm going to fade it. You want, as I say many times, to wait for a market confirmation. And this day in gold, quite frankly, which was Thursday, was the market confirmation. You see that reversal day thing gapped up to a new high, closed down on the day while risk assets were going up, right? While the dollar was going down, while bonds were going up. Those are all bullish gold things. And yet gold closed down, had what they call an outside reversal day, closed down. And then the thing, you know, lo and behold, the employment report came out, blah, blah. The thing got rocked today. So that's how you want to do it. So those are kind of trades that worked, all right? Not all trades work. So, and not all of these things are set up, not set up, but when they're set up doesn't mean they happen. You have to wait for that market confirmation. So let's look at an example of that. This is one that I have been, I would have to say, bearish on, right? Because of the Commitment of Traders report, right? Orange juice. Now, orange juice is like exactly what I look to short, all right? Because articles are coming out every day about orange juice, how the frost and the hurricanes, and you have the smallest orange juice crop in Florida ever, and there's a huge shortage, and this and that. And here we have the Commitments of Traders, where speculators are getting mega long, commercials are getting mega short. So I am looking to get short, but I'm not going to short until there's market confirmation, right? Which is some kind of failure, some kind of reversal day. There's the orange juice chart. You're literally move from 200, you know, to 240, 20% move in a week, right? Getting in the way of that would have gotten you run over. So you have to wait for the market to confirm it first. Okay, the news is super bullish. Okay, the Commitments of Traders is showing that people are too long. You have to wait for market confirmation, and the combination of those two things puts you in a good risk-reward trade. Doesn't guarantee anything, but puts you in a good risk-reward position, which is all we are trying to do over time. Nobody can predict the future, okay? I made a couple good calls the last couple weeks. Okay, does that mean that my next call is any good? Nobody can predict the future, all right? And just because somebody was bullish and the market went up, or somebody was bearish and the market went down, I mean, it's a 50-50 shot. If you line up 1,000 people and have them call heads or tails and flip a coin, at the end of 9 flips, there's going to be one guy standing who called 9 flips in a row, heads or tails. You know what the chances of him calling heads or tails on the next flip are? I guarantee you, 50-50, all right? But what you want to do on that flip is, if you're going to bet on it, you want to get paid 60 cents if you're right and 40 cents if you're wrong. And you want to do that as many times as you can, because we know it's going to come up heads or tails 50% of the time. And if you can get paid 60 and lose 40, then over time you're going to make money. That's what positioning and sentiment does, right? I don't know that it necessarily changes the odds of something happening, but it changes the payoff of something happening. And if you want to say, hey, the NASDAQ went up because the Federal Reserve was more dovish than you thought, then that's fine, okay? The point is, going into it, before we know what they're going to say, everybody knew that they were going to be hawkish, okay? Everybody was bearish going into it, all right? So it changes the odds. If they're hawkish, maybe the market goes down a little bit. If they're even a little bit less than hawkish, which if you want to say they were, fine, then look what happens. The market rips. It changes the payout, not the odds. And that's what trading is all about. And that's what these markets are all about, all right? Say it again. Sentiment and positioning. The rest, quite frankly, is just bullshit for people to talk about, because they spend all their money on getting an MBA and getting a CFA, right? And they can't admit that they just spent all that time and money learning something that doesn't help them in the market. You know, are the fundamentals, do they matter? I mean, they matter, but they're discounted in, because all of these people that got MBAs and CFAs are smart and able, and they already know this information. There's nothing there. So you've got to fade the mass psychology and positioning, okay? So I hope that helps. I hope I didn't ramble too much, but I just think, like I say, these last couple of weeks were the perfect laboratory for this stuff. So let me know if you have any questions or comments, and please join us on Crowded Market Report, where we talk about all this stuff, and we have the charts and Discord, and it's real fun. So hopefully we'll see you there, and I wish everybody a good week.